Now, investment options like fixed deposits, stocks, mutual funds, and gold are quite popular. But of late, many alternative investment options have also sparkled curiosity among investors. Now, the list of alternative investments includes hedge funds, private equity, commodities, real estate, venture capital, private debt placements, peer-to-peer lending, investing in startups, etc. and etc. Many investors, especially HNIs, family offices, and some retirees, use these instruments to generate passive and recurring income. Now, interestingly, these products promise 11 to 13% of returns. Such returns are quite appealing, especially against traditional investment products that offer 5 to 7% of return. Now, besides most alternative investments that are not linked to stock or bond markets, as a result, they help you diversify investments beyond traditional market products. Now, in this video, I will explore 4 alternative investment options and examine how these investment options work, the risks they carry, and the returns they can deliver it to you. Alright, first one is the P2P lending. The peer-to-peer lending concept is almost similar to functioning of a bank. Now, in a traditional setup, the bank keeps the difference they get from interest paid and interest earned. The bank also sets many rules, terms and conditions on who can borrow, how much can be borrowed, what interest can be paid, etc. Now, modern P2P lending platforms have been built by eliminating the requirement of banks from the picture. As a result, the lenders or investors can earn extra interest on their money. Now, in essence, P2P lending platforms like Facent, Lendbox, Liquid Loans, and Rupee Circle act more as facilitators and risk mitigators. Now, during the process, they provide a spectrum of facilities. Now, lenders can select borrowers as per their preferred profile, the purpose of loan, and tenure. The desired interest rate ranges from around 12 to 35%. Understandably, lending money to anyone is never risk-free, and there's always a chance of defaults. Nevertheless, if you are keen on exploring this avenue, please ensure to keep these points in mind, which are, let's say, research the platform for credit checks, never go blindly by interest rates on offer, assess the borrower profiles carefully before giving the loan. Always lend to multiple borrowers rather than just one to spread the risk, and start with smaller sums of money to see if the instrument suits you. Second is fractional real estate. Traditionally, investing in real estate requires capital ranging from at least few lakhs to few crores. But now platforms like Strata, PropShare, etc. have made it possible for retail investors to own commercial real estate in smaller proportions. The business model starts with the fractional ownership platforms identifying an investable grade A property like commercial building or a warehouse. Now, the identified properties mostly have existing tenants locked on long-term contract, resulting in cash flow visibility. Now, since the price of owning properties would cost a few crores, the platform invites investors to pool money to finance the acquisition of this asset. The minimum commitment for investors start at rupees 10 lakh, but it may vary from different platforms. Now, after pooling the money from multiple investors, the platform creates a special purpose vehicle, which is SPV, to acquire the property, and the investor becomes a shareholder in that company. Now, fractional ownership companies generally charge an annual asset management fee of about 1%. They also take in share of profits of a particular rate. Now, from an investor's perspective, like any real estate, the owner receives a monthly rental income with built-in rent escalations. Additionally, the investor also benefits from these properties' price appreciation over the years. So, the fractional ownership platforms promise to offer rental yields of around 8 to 9%, which is higher than traditional real estate, around 2 to 6%. Moreover, if you factor in property value appreciation, these deals seem to target a pre-tax average annual return of say 12 to 15% over a 5-year period of time. Third is high-yielding fixed income investments. Now, for the last 2 years, fixed deposits returns are struggling to match the inflation rate, but that's changing now. We see a boom in starting up offers, bonds, structured debt, and other high-income fixed income securities to retail investors. Along with offering high interest rates, they also allow investors to put in amounts as low as 10,000 rupees. Now, platforms like Wintwealth, Bondcart, Altify, etc. offer government bonds, AAA rated securities, high yielding BBB rated corporate bonds, private bond placements, and etc. Now, hence, investors can choose from a host of products, yields, credit protections, and liquidity. Also, don't just look at yields. Though all these products are sophisticated, some offerings can get a bit tricky if people continue to base their investing decisions purely based on yield offered. Now, case in point, some platforms offer a product that is referred to as senior secured bonds. Two main words here, senior and secure. Okay, the term senior means that these bondholders enjoy a first priority in terms of repayment of principal and interest in case of any default. Another term, secured, means that these bonds are backed by collateral like a pool of personal loan, gold loan, etc. This is just like adding another layer of protection. Alright, fourth is invoice discounting. Now there is usually a time lag between a vendor supplying goods or services and the price he gets at the end. To manage cash flows properly during this period, vendors approach either a bank or a financial institution. The bank then purchases these receivables at a discount for upfront cash. Now many platforms like CredX, Giraffe, TradeCred, etc. have skipped the banking connection. They match vendors and investors keen to participate in this financial opportunity. Now invoices can run into lakhs and even crores. These platforms break up invoice into manageable parts, allowing investors to buy a fraction of the unpaid invoice amount. Now the minimum investment amount keeps changing from a deal to deal, but in some cases transactions start from rupees 50,000 onwards. Now these opportunities typically run from a short tenure of 30 to 90 days and pre-tax average annual return can be as high as 15%. Now, how should investors look at these alternative investments? All the alternative investments we discussed are pitched as high return alternatives to FDs. You can also see them as diversification tools with a little correlation with traditional asset classes like equities, bonds, gold. Now, for example, most of these platforms and structures have a short track record and might not have been stress tested enough. Secondly, there's the ever-present credit risk, especially when one is involved in lower rated papers and when a solution needs the cooperation of, say, multiple parties. Thirdly, there is a liquidity concern. As there is no active secondary market to sell alternative investments, there's a risk. Finally, a lack of regulatory supervision, which can be a big problem when things go wrong. So these are some of the risks that every investor should consider. It won't be prudent to consider these investment options as replacements for your bank fixed deposits or debt mutual funds. Now, if you are keen on dipping your toes in these waters, then recommendation would be to not expose your 10% of your fixed income portfolio. Hope this video was useful and have given you idea for your alternative investment options. Make sure to hit the like button and subscribe button. Also share it with your friends and family to increase the financial awareness. And that's it from me. I will see you in the next.